Morning, everyone. This is Brad Matheny. Today's the 9th of January. It is a holiday trading day. Jimmy Carter's funeral, I believe, is today. President Biden enacted this holiday, no trading today in honor of Jimmy Carter. But there was a question the other day about my cycle patterns. And so let's come back over here to the actual cycle patterns. They're not there. One second. This is where I keep everything for everyone. And there was a question the other day about the cycle patterns, saying that one person wrote that they don't take into consideration economic data or Fed data, FOMC decision data. And that is true. These are based on Gann and Fibonacci time price cycles. They are very unique in the sense that they reflect a more general, not news-based characteristic, because news is something that can disrupt market cycles, as you're well aware. But my deeper research related to, for example, the post-election range bound activity, which is done by my adaptive dynamic learning system. This is the adaptive dynamic learning system, which is kind of an inferred knowledge system based on proprietary lookup and modeling routines, which has been pretty accurate so far, uh, predicting the anomaly event and predicting the deeper lows, particularly in this and XLE and others. Remember, you take a look here, XLE predicted we were going to get down to potentially down into 74 area. And we come back over here. They go to XLE, and you can see here, this is 10-minute, so daily, auto scale. You can see from the election, we predicted that, and this is kind of important, but from the election, we predicted a high range up here of 97, a low range down here of 83. This is what actually happened. And now we're climbing back up. My ADL predictive modeling system predicted a high up here at about 96, 97, maybe up into the hundreds. Where did we get to? Got up into the 97 area beautifully. We came back down here into the lows, down in the 80s. Let's call it 80, 82, maybe down into 76. We come down here, 80, 82, beautifully right down here, never hit the 76. So we had a big, beautiful roll. It was absolutely, in my opinion, stunning. When you think about the fact that we predicted, this rolling event setting up into this time frame, and now we set up into this normalizing, this contracting event. So again, there's very few people, in my opinion, who can predict 4, 5, 6 months into the future, and can hit these levels with this degree of accuracy. But today, I wanted to show you guys something else. The actual extended research that I do for my subscribers every week, and for you guys to understand that it's not just about my cycle patterns. So here we have my smart money index, which measures trending and congestion. So we come in here, I'm going to give you a brief run through on some of these so you can see where we're at. And this is how I kind of, not that one. This is how I kind of, judge the market conditions. There's a number of these. So ideally, when we're in an uptrend, we get this kind of a bouncing low down here. And when we're in a downtrend, we get it bouncing off the highs up here. So when we shift trending modes, we go from bouncing off the highs up above these levels to starting to bounce down exclusively off of these lows, which means that we're in an uptrend, and Every time we get one of these bounces like we see here, this is what I call the disruption zone. This is where we'll typically get a base or a bottom. So you can see here, we get this base bottom here, rolls up. That's our base bottom here. Get our base bottom here, rolls up. That's our base bottom here. Get our base bottom here, rolls up. That's follow that up. Our base bottom right here. Base bottom right here, base bottom right here. Little tiny base bottom here, moderate base bottom here. A little tiny rotation base bottom here, base bottom here. Now we have the current base bottom, right? Moving into trending. That's why I believe that we are going to be moving up into upward trending here. And this is one of the basis for my belief that we are looking at a move back into trending right here. Predictably, probably high probability to the upside, given all of my extended research. Now, secondarily, we have, let me come over here and find it, the market ratio index. Now, the market ratio index is a measure, monthly measure of consumer sentiment and consumer activity. Now, we have been moving into this kind of consolidated low channel right across here for a number of months, all the way back through the beginning of 2024 and back over here, 2020's lows. And my expectation of these lows, given where we've been down here near these lows, is that we are going to transition through a recovery phase back up into this area, meaning that we are going to see the markets attempt to roll back up into this kind of a topping area, not getting up into this extended, exuberant area, but moving back into a fairly solid trending mode, but I think it's going to take a couple of months to get there, meaning we're not going to get into a big solid rally until after Q2 of 2025. So, again, the research here is designed to help me determine what the market is actually doing. Now, we also have the SPY base trend index, which is a measurement of what I call dollar demand. And I measure this with dollar demand in terms of what gold and silver is doing, plus the strength of the dollar. You can see that we've had this big, beautiful, oops, edit, pencil. You can mark up. You can see we've had this big, beautiful rally and this big, beautiful rally back here in 2023. That's the end of 2023. Consolidation, dollar demand was still strong. Remember, basically, this is our, let's call it zero line for dollar demand. So really, dollar demand is still stronger than normal, but weakening through this cycle. Then it builds back up, and now we're in a weakening cycle. What does this weakening cycle mean? It means that the markets are attempting to temporarily consolidate. You can see through these expansion cycles, we get solid growth when the dollar demand increases. So now we're rolling down into these lows. Okay. These lows, this low zone, if it holds up and rolls higher, will roll us into higher price accumulation. And I think a roll into a new Trump economy may be powerful enough to do that. Remember what happened in 2017, which I can show you back over here. Let me see an example of what to show you. So we come back over here, some of my other analysis. We have the devaluation cycle phase index is flattening out. Again, we would look for appreciation. We're getting a base just after the election. So we've gone through the election. We've seen this devaluation phase. We're looking for a roll back to the upside. We have the accumulation phase index monthly chart still moving into slightly bearish territory. This was as of the first week of trading in January. So this has got to go through the full month. This is a Heikin-Ashi chart. So if you know anything about Heikin-Ashi, this open is not realistic. So I'm taking this with a grain of salt, knowing that we have this rolling trend in the smart money index. I believe that we're looking at a fairly solid rally trend back out of this. I expect the 2025 to see somewhere between a 12 and a 16% rally phase in the SPY. So I would expect this to roll back downward a bit. Maybe not reaching these lows. These were the extreme lows in 2021, 2022, but certainly potentially getting back down into this area a little below. We'll see how it plays out. Let's come back over here, figure out where I'm at. There we are. So that looks like the leading index, this is weekly, is weakening through this trend back over here into these, into these previous lows, back over here into June, July lows. And remember, I tell you guys about apex levels being critical support resistance all the time. This is a solid apex level. So that's why I'm believing that the data that we've got, particularly the shift back into trending, is going to roll to the upside. And again, the shift into trending, for you guys who don't know, is right here. This chart, the smart money index, is the shift into trending. And again, I've highlighted it all the time. Base bottom trending, base bottom trending, base bottom trending, base bottom trending, very deep base bottom moving into trending. So here we go, base bottom moving into trending, base bottom moving into trending. So you see how these bases and these bottoms typically roll into very solid trending in an uptrend. Now, we don't have any real indication that we've moved into extreme peaking. Typically, what would happen through extreme peaking is we would see a roll and then a shift right back up here into this topping formation. We don't have that yet. So we are still in fairly strong bullish trending. Now, let me come back over here. One of my favorites is the volatility index. You'll hear me talk about this, fairly common. The volatility index is a measure of, I try to explain it as like an RPM, a tachometer. So if you know anything about a tachometer, it's the speed at which your engine is rotating, how many RPMs it's making. So when we get up into this upper channel like this is extreme high RPMs. And when we get down into this lower channel, these are extreme low RPMs. So anything in between is valid. Okay. And what we're looking at here is this is giving it gas to the upside, and this is pulling back generally to the downside. This is giving it gas. This is pulling back, giving it gas, pulling back, rotating through the pre-election time frame. And there goes my. And then now we've gone through this up, down, up, down, up, down. Now, where do we go? Okay, I believe we're going to roll into this moderate upside mode through the inauguration and then potentially move back down into a deeper low. Like I said, I do believe that the first 2 quarters of 2025 are going to be fairly difficult. So again, getting that moderate upward trend, getting that trending indicator suggests that we're going to see an upward momentum swing here in the markets moving into the inauguration. And We'll come back out over here, skip some of these. Can show you this one, smart cash index, moving back into a flagging formation. Very interesting how this flag here is setting up in the apex level here. I believe that this is going to be a key rotational area for the market, key support and resistance. Remember, generally markets tend to want to go up. The reason being is that traders and investors and the economy itself, human psyche, does not enter into a trading or a life cycle mode where we have um, failing expectations. So again, that's why the market, I did a whole video on this a year and a half ago about all these top, all these people that predict the top. And I can show that to you back over here, traders that come out and, oh, the market's topping, oh, the market's topping. Well, you know what? This is what they look like, in my opinion. So, they basically come in here and go, oh, top. And then they come out over here and they scream top. And then they come out over here and they scream top. And they come out over here and top. And then over here, top. And then over here, top. And like I said, they go all year long. The market's topping, the market's topping, the market's going to crash, and they predict this stuff all the time. And it's like, oh, the market's going to crash, the market's going to crash, the market's going to crash, the market's going to crash. And so they go through this, and they literally will come out and tell you that, the market's going to fall 35%. Okay, well, there's your 35%, 45% right there. And again, it just seems ludicrous to me that, yes, there are periods of time when you have to be cautious of a market collapse. Okay. It does happen. And you're going to get periods like right over here when the Fed started raising interest rates that you're going to get some sort of a collapse. But generally, I mean, this is the SPY, and generally, you don't get collapses. Look, this is going back almost do the math here, 30 years, 35 years. Generally, you don't get collapses. You don't get breakdowns. And that's the point I'm trying to make to you is that, it has to take a special set of circumstances for the markets to particularly break down. And in this case, it was a global financial crisis. Back over here was a dot-com bubble and the 9/11 event actually came in back over here. 9/11 was very late in this cycle. But again, these top sayers and the fact that, you can play short term rotation. I have no problems with that. I think that's smart. But, betting that the market is going to go down all the time, yeah, no. I mean, rotations, yes. And like I try to tell people, look, a simple rotation is going to be, 8 to 15% typically. Here's COVID, very strong collapse, 31. But a typical market rotation is going to be 8 to 15%. In a lot of cases, just only 5 to 8%. 8% is a pretty common number, actually. You can see here, 5 to 8% generally on a pullback. So here we haven't even pulled back 2.5% yet off of these lows, close to close basis, but lows maybe 4.5%. And like I said, we've got this. If you take a look at this measurement from here to here to here, yes, we've just touched the 100% measured move. Okay, right up here, just touch the 100% measured move. We're going to be expecting some consolidation, but I will tell you this, that we're moving into and this is my expectation. I don't know if it's going to come true, but I believe Trump's going to try to straighten out some of the spending issues in DC. I believe he's going to run into some headwinds that they're not going to want to try to ease spending. But I believe ultimately he will attempt to move the budgeting and spending issues into more restrictive um, business like type of environment, meaning DC is no longer going to be able to go out and just, spend on, purple pigs and they want to see if they can create them. Uh, you know, I that kind of stuff I just don't get. But yeah, I get that it sparks economic activity, but I don't get that it really helps us in any way, shape, or form. Who cares about purple pigs? But the long and short of it here is I think that because we've gone through this COVID, then again, this was really, you think about this, and so Biden gets elected here November 20th. Look at where the election is compared to going over here. This is pretty much Biden's realm in the market. So from here on. So, we'd already recovered pretty much from COVID. We already had moved the markets into a new high type scenario by the time Biden took office. And we've seen this expansion grow, considerably. Literally, we're at a 100% expansion right now, reaching this top. Now, I would expect to see a 1.15 or a 1.382. So we'll see how it holds up. I think we could get some consolidation here before we move on out, but not a major crash. And like I said, we've had this very solid rally phase, primarily off of the Biden spending and the DC spending spree, as well as the Fed. I mean, remember, the Fed kept interest rates low until about this period, then raised rates, has recently been decreasing rates over here, but again, I don't. I see the Fed's going to have to move rates higher to try to stop this inflationary trend, unless they're able to break down the money supply and money flow situation. And I just, like I said, I see that we're going to move into, in my opinion, a consolidation phase here in early 2025, still rolling up, down into second half 2025, which I think we're going to take off. So my research is very detailed in the sense that I spent a lot of time looking at other data, and that's what I really wanted to talk to you about. Now I'm kind of rambling. Let me show you here. Very interesting that we're getting this inverted head and shoulders formation here on the valuation trend index. I think this is what's going to play out over the next month or two, is we're going to roll into sideways trading for maybe 2 or 3 or 4 months and then break out to the upside. That's the second half of 2025. Come back in here. Where am I? Back over here. Okay, US markets and global markets are trending downward. As long as this continues, we're going to be in a somewhat downward consolidated trend. Again, I've highlighted this before. The global market index in red tends to lead the US market. We're in this downward cycle trend. You can see the flagging set up here. We're looking at some sort of a breakaway, breakdown type of pattern setting up, and like I said, I think it's going to be more of a breakaway move for the first month or so after Trump gets inaugurated, but it's going to be very interesting nonetheless. Okay, so let's come back over here to this should be consumer sentiment, consumer engagement, and consumer engagement has pulled back after the last election. This is December, reaching a high back up here where I suggested it would, and starting to pull back. I think that's because of the inauguration and people don't know what to expect. We just got past Christmas. We had a nice little bounce in Christmas. This pause stall could continue for many, many months, just consolidating back downward again towards these lower levels. And that's about it. So I can show you here. Commodity to gold index is this is a good measure of kind of economic activity. And you can see that we've had these support levels across here. lining very cleanly with our flagging area right there. We are through this pullback, through this consolidation, flagging, rotating, trying to break out. And now, like I said, it looks like we're setting up another flag apex that's going to align. This is weekly. So, we've got basically 2 or 3 more weeks right into the inauguration uh, that's going to come in here and play out. So I want you to be aware that, whoops, get rid of those. We're basically moving through this low flagging cycle, potentially back up here to the upside. And that's where I believe that the markets really want to go. And again, particularly when I come back over here and take a look at this, the smart money index is saying trending, is telling me that we're doing this. So we're getting a consensus data that we're moving into this mode, this type of an upward mode, hammering out a base or a bottom, which again, if we come back over here and come back to the SPY, clear all of this and come back in here to daily, what we're looking at here, folks, is a big pullback, kind of like this, trying to hammer out this bottom, looking for a rally phase to move into the inauguration. And maybe reaching new all-time highs at this point. It kind of looks like that's a good possibility to me. Now, as I mentioned to you, a breakdown of this low would be an indication that my upward analysis has failed and we are now going to break to the downside. But what I wanted to do today, we have a holiday, is to talk to you about all of the research that goes into, identifying what these trends are. So remember, I'm blending not only my cycle patterns here into expectations related to my custom indexes and my ADL or predictive modeling systems, but I am also blending all of this into my, where are they? Right here. Daily cycle expectations and weekly cycle expectations, which coordinate with the broad term extended cycle yearly cycles. So, what I'm trying to do, guys, is I'm trying to, stay ahead of the market, use the data I've got, and it's not just these cycle patterns. That's what I'm really trying to tell you. It's not just these cycle patterns that I'm showing you. I'm trying to basically highlight these cycle patterns, but give you the context of what is happening behind the scenes with all of this other data. And that's where we come into, well, not that, looking at this data, looking at all of this extended research data, telling us what the markets, what we believe the markets are doing based on factual numeric data. Okay. So, for example, the fear index is, let me show you the fear cycle index. Here we go. Fear cycle index is, oh, wrong one. Fear cycle index is elevated off of this low. That's normal. Sentiment index is basing and bottoming. SPY here is still in a bullish trending mode. We're basically moving into a bit of a fear cycle event. We don't know what Biden's going to do. Don't know really what Trump's going to do. Don't know what surprise is going to happen. Drones everywhere. Terrorist attacks through the new year. I think people are going to be a lot more complacent, a lot more settled after the inauguration event takes place. But we'll see. Right now, I think there's a lot of anticipation, which is why we're getting, like I said, some of this really wild price activity. But in my opinion, we're setting up that low rotation rally mode that I believe is still working itself out. And this, wherever it is telling me that we're moving back into trending very cleanly, moving back into trending. And when we get into trending, you can see we can roll up, we can roll through consolidation here. Let me show you. So here's a nice deep low, right? Boom, boom, kind of like we had here. Boom, boom. Well, we move up into trending right off of this low. Then we struggle a bit and eventually we move up. And you can see how we've moved into this kind of flagging upward mode above those lower levels and still managed to rally off of this, 508, 510 area all the way up to 600. So if we move into that type of a mode here where we roll off of this, we could move up into 630, 640, maybe 650 off of a fairly strong kind of consolidation phase, maybe out over here, just trending upward. It doesn't always have to just go straight up. Sometimes you can get this moderate upward. Like here's another example. Big rally up off of this, rolling back down, and then we stayed in this kind of a downward trend, still above the deeper lows. And look at what happened. We rolled all the way up from 370, 380, all the way up to 450. That's a big move, guys. That's a very big move. And we just went through the election event right here. So remember, October, November, deep low, consolidation. Now we're moving into the new year, rallying forward. Guess what? I think we're looking at a good, solid rally coming out of this. Okay, so I know I've wasted a lot of your time, but pay attention to what's actually going on. It's a holiday today. Yep, 32 minutes, way too long. And remember, my research is not just, the cycle patterns. Behind the scenes, I'm doing quite a bit of research for everyone, trying to help you guys out, trying to build tools to help you, trying to build systems and algorithms to help you. And it's more than just the cycle patterns. I highlight the cycle patterns because I like them and I think they're of value. But I don't have, 3 hours a day to go over all of the charts with you and all the research that I do. It's not just the cycle patterns, guys. All right. Remember, take a day off today. Markets are very flat. Probably not going to see much of anything happen today. Okay. Talk to you later.